Welcome to the Paragon Podcast, a podcast focusing on the needs of high net worth individuals and their families. We discuss the markets, tax strategies, and how to better manage wealth with the goal of living better for today while planning for tomorrow.
Hello and welcome to the podcast. I'm Elean Mendoza and I'm here with Evan Shorten, the firm's founder and principal.
Hello everyone, thank you for tuning in. If you have not had a chance to subscribe to the podcast, please do so on Apple Podcast, Spotify, or YouTube.
Okay, so let's jump right in. In this episode, we're going to discuss tax loss harvesting. As the end of 2024 is approaching, tax loss harvesting can be used as a last-minute tax strategy to hopefully lower your tax liability. Evan, do you want to discuss what tax loss harvesting is and why someone might want to consider it before year end?
Of course. Tax loss harvesting is a fairly common strategy that any investors can use to potentially lower their tax liability by realizing losses on a specific investment and then using those losses to offset realized gains or to offset a portion of their income. One of the things that makes tax loss harvesting a great option late in the year is that it's fairly straightforward and simple to implement. There's a few caveats to keep in mind, but we'll talk about those as we go on.
Okay, so what does it actually mean to realize a loss?
Well, it simply means selling an investment that is currently sitting as a loss. For example, let's say you bought 100 shares of Nike back in March of this year when it was trading around $100 per share for a total investment of $10,000. You can now sell those shares at $75 and receive $7,500 in proceeds with a realized capital loss of $2,500. In this scenario, we realized a $2,500 loss.
Okay then. So now that we realized the $2,500 in losses, how do we actually lower our tax liability?
Well, we have a number of options. First, we can potentially reduce any capital gain that has been realized. For example, if we sell a stock or an exchange-traded fund and make a $5,000 profit, we can reduce that profit with our capital loss. Using our $2,500 capital loss example, we would only owe taxes on the $2,500 net gain instead of the $5,000 gain. Where this becomes really useful is when we can tax loss harvest across different asset classes.
Right, and that's because tax loss harvesting isn't limited to one asset class, nor does it require you to apply tax losses to the same asset type.
Exactly. So if you have a large capital gain in something like Bitcoin or the sale of a home where the proceeds exceeded the capital gains tax exclusion, you can harvest tax losses in your brokerage account to offset some of those gains and reduce your tax liability.
Okay, so what if I'm the type of investor who keeps a fairly consistent portfolio throughout the years and I'm not ready to sell or reduce any of my winning positions yet?
One of the simplest things you can do is reduce your taxable income by up to $3,000. In other words, if you have no capital gains in your portfolio, realized capital gains that is, or across other assets, you can simply reduce your income by up to $3,000. That's a fairly straightforward way to take advantage of any losses in your portfolio. Additionally, you can offset future gains or income with what's called a capital loss carry forward. If you generate more capital losses than you can use in a given year, you can carry those losses into the future indefinitely with no expiration. For example, let's say I realized $9,000 in capital losses this year. I could deduct $3,000 from my income this year in 2024, $3,000 from my income in 2025, and the remaining $3,000 from my income in 2026. I could also use the same capital loss carry forward to offset any future capital gains across any of my assets.
Okay, all that sounds good, but what if my losing position is one that I want to own for the long run? Using our Nike example, what if I'm actually bullish on Nike long term and I want to hold the position for the foreseeable future.
This is where those caveats we alluded to earlier come into play. Tax loss harvesting does not require you to abandon your long-term allocation or give up whatever conviction you may have. You can actually buy the position back after realizing the loss. There are, however, a few rules you have to adhere to in order to legitimately realize the loss and buy the position back. First and foremost, you need to be aware of the wash sale rule. In order to realize the capital loss, you cannot have bought the security or a substantially identical security 30 days prior to selling it, and you cannot buy it back for at least 30 days after selling it. This is extremely important, and if you don't adhere to it, the capital loss will be a wash, hence the name wash sale rule. Additionally, the wash sale rule applies across all of your accounts. In other words, you cannot sell an investment for a loss in your brokerage account and immediately buy it in your IRA or trust account. The wash sale rule looks at your ownership across all of your accounts. This also includes joint accounts you might have with your spouse or children.
Okay, here's another question. When I sell a position for a capital loss, I'm going to be in cash for 30 days before I can buy the position back. What if I'm concerned the market might move higher while I'm sidelined in cash?
Well, depending upon the specific position you sell, you may be able to find a substitute that you can buy and hold for, those 30 days. The wash sale rule has a specific requirement that stops you from buying the same security or a substantially identical security within 30 days of buying or selling for a loss. If we continue to use our Nike example, then this isn't much of an issue since I can't really think of anything that is substantially identical to Nike. We could take the sale proceeds and buy, for example, Under Armour, Adidas, or a diversified exchange-traded fund that contains Nike within it, since none of those positions would be considered substantially identical. However, if you sold something like a physical Bitcoin for a loss, you cannot immediately buy a Bitcoin ETF, as that could be considered substantially identical.
So as we wrap up the episode, we need to mention one last item about tax loss harvesting. And that's the character of the capital loss matters. So what do we mean by character? The character refers to whether the loss is long-term or short-term. When harvesting tax losses, losses of the same character offset each other first. Meaning, if I harvest short-term losses, those losses will be applied to any short-term capital gains first, and the remaining amount of short-term losses will then be applied to any long-term capital gains I have. Conversely, if I harvest long-term losses, those losses will be applied to any long-term capital gains first, and the remaining amount will be applied to the short-term capital gains. So, to wrap things up, tax loss harvesting can be a good strategy to potentially reduce your tax liability with the added flexibility of deferring tax losses into the future. Just make sure to be mindful of the wash sale rule. With that said, thank you for tuning into the podcast. If you have not done so already, please subscribe on Apple Podcasts, Spotify, or YouTube. Thank you again, and we'll see you here next time.
The Paragon Podcast is brought to you by the professionals at Paragon Financial Partners, a registered SEC investment advisor. The topics discussed herein are for informational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The financial strategies and guidelines discussed herein may not be appropriate for everyone, as each individual circumstance is unique. Please review all tax information with your tax professional. Please review all legal information with your legal professional. If you have any questions or would like additional information, please visit our website at paragonfinancialpartners.com or email us at info@paragonfinancialpartners.com.